People love to make cryptocurrency look incredibly intimidating. The assumption is that to even step foot in the market, you need thousands of dollars in capital, a desk covered in 6 monitors, and an iron stomach for risk. I wanted to test the reality of that assumption, so I ran a strictly documented experiment. I took exactly $100 and I committed to holding it in the crypto market for 30 days. No algorithmic trading bots, no insider tips. I tracked every cent I bought, every swing in the market, and most importantly, I documented how I reacted when real money was suddenly on the line. By capping the downside at $100, the risk to your actual livelihood is 0. This creates a controlled environment to observe how you handle volatility without jeopardizing your rent. Before opening a single app, I set 3 strict rules to keep the experiment honest. 1. I cannot inject external capital into the account. 2. No panic selling, no matter how far the numbers drop. 3. Absolute transparency on the final result. I built the portfolio on a foundation of relative stability. $50 went into Bitcoin, the most established asset in the space. Another $30 went to Ethereum, which acts as the infrastructure layer for Web3 development. For the final $20, I wanted exposure to a more aggressive tech sector. I bought Solana. It moves faster than the major coins, but it carries a substantially higher risk of crashing. Total investment allocated, exactly $100 on day 1. Splitting the capital this way utilizes diversification. If my high-risk pick collapses, the established coins act as a buffer, protecting the baseline while still leaving the door open for high-growth swings. This chart tracks the portfolio over the 30-day timeline. By the end of week 1, the line surges to $112.40. The main catalyst was Solana, which spiked 18% in just a few days. Look at that total return, 12.4% in a single week. Staring at those green numbers on my screen, I felt this intense, intoxicating rush of success. Immediately, my brain started scaling up the math. If I had deposited $1,000, I'd be up over $100 for doing nothing. The temptation to break my very first rule and wire in more cash was overwhelming. Early, rapid financial gains are a psychological trap. They condition you to expect constant wins and build a false confidence that often leads novices to risk heavier capital right before a correction. Notice how violently the trend reverses here in week 2. Negative macroeconomic news hit, the market contracted, and my balance went plummeting straight through my original entry point, landing at $94.80. The asset that pulled me up the fastest is the exact one that dragged me down. Solana dropped 22, but mentally, I was a wreck. I was waking up at 2 a.m. to check my phone, obsessing over every minor fluctuation. Behavioral economists define this reaction as loss aversion. Our brains are hardwired to feel the pain of losing money twice as intensely as the joy of gaining it. Extreme volatility is a structural feature of crypto. If you fight those mechanics and let every dip dictate your mood, the emotional exhaustion will force you out of the market. Week 3 delivered constant, unpredictable whiplash, up on Monday, down on Wednesday. But eventually, the balance dragged itself back into profitable territory at $108.60. To survive the roller coaster, I had to implement a behavioral intervention. I restricted myself to opening the crypto app only once every 24 hours. Look at the difference in how this data is framed. On the left, tracking hourly micro-movements looks like absolute chaos. It breeds anxiety. But view that same exact data on a 7-day timeline on the right, and the noise smooths out into a gentle, readable curve. Deliberately starving yourself of real-time notifications forces you to evaluate the market rationally. It effectively neutralizes the panic that drives people to hit the sell button at the worst possible time. When day 30 arrived, the numbers stabilized, ending at $118.40, an 18.4% total return. For perspective, look at the bottom line. A standard savings account trickles out barely 0.5% in interest across an entire year. The math is real, but my timing was lucky. If I had started this experiment a week later, that profit could easily be a loss. Past performance never guarantees future returns. The final profit of $18 is a secondary outcome compared to the psychological conditioning achieved during the 30-day timeline. The diversified strategy worked exactly as designed. When the riskier coins collapsed, the heavy allocation in Bitcoin kept the floor from falling out. I felt the immediate urge to buy at the absolute top, and the terror of holding at the bottom. The difference between a profitable month and ending the month in the red was the discipline to ignore those impulsive emotions. Take a $10 or $20 bill and lock it into a volatile market. Don't treat it as an investment strategy. Treat it as a mandatory tuition fee to learn exactly how you handle fear, greed, and risk.